we are still in a bull market for Bitcoin. I know we ended up in a bear market by some metrics during or right after so-called Liberation Day, early April. But Bitcoin has maintained its uptrend relative to gold, did not break. And I think that's a very, very positive thing. It's still in the bull market as our on-chain analytics led by David Puel suggest. And I do think you can say the same now about the equity markets. I really love bull markets like this because what's happening is the equity market is climbing a wall of worry. And what's been fantastic about this time around is it has not been an unhealthy bull market like it really was from 23 to 24 when the concentration towards just a few stocks was at its extremes. The market is broadening out, so it's much healthier now.
Bitcoin is still in a bull market. It stayed strong through the sell-off after Liberation Day in early April and held steady again during the fallout from Israel's bombing of Iranian nuclear sites. Even with rising global tension, Bitcoin didn't break its broader trend and continued to outperform gold. On-chain data shows steady accumulation, which suggests that long-term holders and institutions are not backing off. With increasing demand from ETFs and growing international adoption, Bitcoin's position as a long-term asset appears stronger than ever. According to ARK Invest CEO Cathie Wood, the same kind of resilience is showing up in the stock market. Despite worries over tariffs and weak growth in some sectors, the rally is widening. More industries are joining in, which usually signals a more stable recovery. A big reason behind that is productivity. New technologies, especially AI, are helping companies do more with less, cutting costs while increasing output. That kind of growth puts downward pressure on inflation. It may run against popular belief, but history shows that strong productivity often leads to stable prices and stronger growth at the same time. If that continues, the surprises ahead may not be rate hikes or deeper recessions, but lower inflation, better fiscal numbers, and a market that keeps pushing forward for solid reasons. Stick around until the end to hear Cathie Wood explain why Bitcoin and the broader market may be entering one of the most transformative phases in decades.
As we believe, reaching the end of this rolling recession with some certainty on tariffs, the tax package, so the big beautiful bill, and the wars, both Ukraine and the turmoil in the Middle East, as those start clearing up, perhaps, or at least some of them. And we do believe we'll launch from a rolling recession into a rolling recovery that we think will gather momentum as we're exiting this year into next year with productivity the big surprise and real GDP growth benefiting. We also think the other surprise will be inflation, much lower than expected because of productivity. Now, a lot of people associate real GDP growth with higher inflation. The higher the growth, the higher inflation. If you look at history, that's absolutely wrong. The higher the growth, the higher the productivity, and productivity is a potent anti-inflationary force. And we think that's going to be the case this time, perhaps more than ever, because of all of the deflationary undercurrents associated with the explosion in new technologies, catalyzed especially today by AI, which is, as we've gone over in the past, extremely deflationary. Good deflation. The more costs fall and prices fall, the more units explode. That is how we usually exit recessions, or in this case, a rolling recession. And we think this time will be no different, except it will be more exaggerated than usual. So we think that the tide is turning here, and we think the surprises could be on the low side of expectations, meaning the deficit shrinking as a percent of GDP more than people expect. Here you can see what I mentioned about M2. M2 is closing in on 5% growth. That's depicted in the purple line here. But if you take a look over history at this chart, you'll see that even that rate is at the lower end of what we've experienced over the years. Now, what's also interesting on this chart is in the 60s and 70s, you'll see M2 growth on a year-over-year basis was outpacing inflation. It was accommodating all kinds of government spending. And you can see that this is pushed ahead by 18 months, that if we're right, the inflation rate is going to come down. And the controversy out there, and I think what Treasury Secretary Besant has been trying to guard against, is that we don't end up in another 70s accommodation period, which led to terrible inflation, double-digit inflation. If we're right, this environment is going to look much more like the 90s, where money growth is above the inflation rate, and actually inflation tends towards a decline. And what that will mean is that the velocity of money is slowing down. Now, the velocity of money, I know I've featured it in charts in the past, but it's been in a secular downtrend since a secular decline. The growth rate had been slowing quite a bit, but the actual decline started in the late 90s. With the occasional cyclical bump. Well, we've just been through the cyclical bump, and velocity is starting to turn down again. So that trend is important. If it's still in place, then money growth at this level is not at all a problem in terms of feeding inflation. The velocity is the rate at which money turns over. And why would it decline? Well, if we're right and inflation is much lower than expected and interest rates will follow, the attitude is, well, I don't have to rush now to buy anything because inflation and interest rates are coming down.
Money supply growth is rising again, but not at rates too alarming. As of mid-2025, M2 is growing at around 5% year over year, according to Federal Reserve data. That's a meaningful increase from the contraction seen in 2022, when M2 declined for the first time in over 60 years. Still, today's pace remains at the low end compared to the 10 to 13% growth rates that were common during periods of post-war stimulus or the pre-2008 credit expansions. Cathie has pointed out that inflation risks remain low, in part because of how slowly money is moving through the economy. Historically, sharp and sustained inflation tends to happen when the money supply grows quickly, and that money moves rapidly through the economy. The latter is known as the velocity of money. It measures how often each dollar is spent on goods and services within a certain time period. Historical data shows that the velocity of money has actually been falling for decades. It reached its peak in the late 1990s and has steadily declined ever since. Today, it's near record lows. That means people and businesses are holding on to cash longer instead of spending it right away. Several factors are behind this, including aging populations, slower consumer demand, and more savings going into investments instead of goods and services. If inflation keeps cooling and interest rates drop, there's even less reason to rush out and spend. That slows money movement even further and reduces the risk of another inflation spike. Let's watch more clips of Cathie Wood to see why she believes this falling velocity, combined with rising productivity and Bitcoin adoption, could define the next era of disinflation and digital asset growth.
I think we have been climbing a wall of worry. I mean, a lot of people expected tariffs and wars, and and the controversy between the Fed and the president to really shake markets up. And of course, there has been some volatility. But these are the kinds of bull markets that I think are the most durable. When the market climbs through all of that controversy, it's really signaling something. And I think the things that it is signaling are interest rates probably are coming down. And I think what many people are not focused on in the inflation statistics are the housing numbers, and they get in there with a long lag. We think that the shift or the concentration towards just a very few stocks, which was a very unhealthy bull market, that is changing, and the market is broadening out. And I think deregulation is probably one of the most important things that this administration is doing. We've been pretty consistent on this idea of we've been through a rolling recession. If you look at housing, which is actually having a little bit of a relapse today, housing plummeted in 2022 when interest rates shot up, and it has not recovered. Manufacturing has not recovered. And so we do believe that they will recover as interest rates come down, deregulation takes hold, some certainty about tax cuts and so forth occur, including immediate expensing, perhaps, of capital goods, which would be very positive. So we think we'll move from a rolling recession into a recovery. But what happens early in a recovery, if you'll allow me to call this that. I know many people think we never went into any kind of slump, but we have, sector by sector. What typically happens when you come out of a recovery is productivity kicks in because companies have been very conservative and especially amid all of the uncertainty. So productivity kicks in and actually drives inflation down much lower than anybody anticipates. And I think that's going to happen this time as well, which is not normal. And you can see how abnormal it has been. We've had that inversion in place pretty much since the Fed started jacking interest rates up dramatically, the most dramatic move ever in percentage terms, in percentage change terms, and it's been inverted ever since then. And this is one reason we believe we've been in a rolling recession, and the headline numbers obfuscate this rolling recession. But if you go sector by sector, manufacturing down and out, housing down and out, small businesses constrained by all kinds of metrics, monetary policy is too tight. So here is real GDP versus productivity. Real GDP is in the purple, and you can see how this rolling recession has been obfuscated, I think, holding real GDP growth up over the last few years as housing has crashed and manufacturing has really been under a lot of stress, has been the government sector, and now that's starting to give way, and the high income part of consumer. And we know from sentiment indicators that their sentiment has diminished as well with all the uncertainty around tariffs and geopolitical risks. So we think the bias here in this number is down. You can see on a year-over-year basis, even during recessions, look at the early 90s, that was the S&L recession. It barely went down. In the tech and telecom bust, it didn't go down. We needed two shocks, the global financial crisis caused by mortgages and COVID to get it down in any big way. You can also see productivity. You can see how it picked up in the 90s. One of the reasons that, as the internet was taking off, one of the reasons inflation did stay very low. And you can see it has been languishing at a fairly low level relative to what we enjoyed during the late 90s. We think we're going back to that level and well beyond in a secular sense.
Based on the data from Cathie, we might be entering a phase where lower inflation and better productivity allow for growth without overheating, which could reset investor expectations across the board. Bitcoin also fits into this. With liquidity returning and traditional assets looking stretched, it's positioned to catch the next wave of institutional demand. If risk appetite grows and rates drop, we could see even more capital move into Bitcoin faster than people are ready for. If Cathie and her team's view plays out, this would be a setup for realignment. One where efficiency improves, inflation slows, and digital assets like Bitcoin take on much larger positions in long-term portfolios. Anyway, guys, before we go, if you want to stay most up to date on the crypto and Bitcoin world, subscribe to my daily 5-minute crypto newsletter. It's a concise resource for the latest expert predictions, breaking news, and top-on-chain analysis, trusted by over 90,000 subscribers for insightful crypto investment information. Don't miss out on the opportunity to stay informed in the crypto market. The link is in the description below. I hope you all enjoyed today's video and that it gave you some value. I'll see you all at the next one, and as always, all the best.